Barclays has just posted first-half pre-tax profit of £6.1 billion, up 17% on the year and comfortably ahead of the £5.9 billion analysts had penciled in. Group income rose 11% to £16.5 billion, with the investment bank delivering a 20% jump as equities trading and deal fees carried the quarter. On the surface, this looks like the strongest possible start to a bumper UK banking earnings week. Barclays didn't just beat on profit, it raised the bar on shareholder returns too. The bank announced a fresh £1 billion share buyback, 20% larger than the market expected, alongside a 5.9p interim dividend, itself 13% ahead of forecasts. Management also nudged its 2026 group income target up to roughly £31.5 billion and reaffirmed a path to a return on tangible equity above 14% by 2028. Here's the part that does not fit the headline. Despite beating on every major reported number, Barclays shares fell 5.6% to 500.8p on the day. A profit beat, a bigger buyback, and raised guidance were not enough to hold the stock up. That is the question this video actually needs to answer. What did the market see that the headline profit figure did not capture?
Analysts at Jefferies called the numbers a slightly messy set, and the detail explains why. Net interest income, excluding the investment bank and head office, missed consensus by 2%, with shortfalls flagged at both Barclays UK and the US Consumer Bank. Operating costs also ran roughly 3% higher than expected, driven by the investment bank, plus around £300 million tied to structural cost actions and up to £150 million from a shifting bonus mix in the second half. The composition of the beat matters as much as its size. Fixed income, currencies, and commodities revenue grew just 1% year-on-year, trailing the pace set by some U.S. rivals, meaning the investment bank's strength was concentrated in equities and advisory fees, rather than broad-based trading momentum. So the profit beat was real, but narrower and more cost-laden than the £6.1 billion headline implies. This reframes the sell-off. Barclays shares had already run up more than 40% from their March lows heading into results, meaning a strong quarter was the expectation, not the surprise. Broker Shore Capital said it expects only modest forecast upgrades from here, because consensus for 2026 income and net interest income was already close to what Barclays itself just guided to. A good quarter that merely confirms an already priced rally gives holders little fresh reason to bid the stock higher, and gives the cost and NII misses room to dominate the reaction instead. There is a second layer of pressure that has nothing to do with trading performance. Barclays' first-half bonus pool rose 30% to £1.3 billion, and the bank's finance director, Anna Cross, called the increase purely mechanistic, tied automatically to higher revenue. But the timing, alongside a bumper profit print, has reignited calls from the TUC for a new bank tax under Prime Minister Andy Burnham, with General Secretary Paul Nowak arguing lenders can easily afford to pay more. Barclays is responding on two fronts. Management is planning up to £500 million of additional structural cost actions later in 2026, on top of £350 million already delivered, aimed at improving returns structurally into 2027 and 2028. At the same time, the bank pushed back publicly on the tax threat, with Chief Executive Venkakrishnan and Cross both arguing UK banks are already taxed more heavily than European and US peers, at a combined 46.4% rate, against 27.9% in New York. Capital strength is not in question. The CET1 ratio held at 14.3%, comfortably within target. So the sourced picture is this. Barclays delivered a genuine profit and capital return beat, but one built on a narrower revenue mix, higher costs, and a rally that had already priced most of the good news in before results landed. The fall was not a rejection of the quarter itself, it was the market finding limited room for further upgrades once the details were read past the headline. What remains unresolved is external to the results. Whether Burnham's government uses this earnings season, and rivals' results still to come from Lloyds, NatWest, and HSBC, as the basis for a bank tax rise at the autumn budget. That decision, not this quarter's numbers, is the next checkpoint that will move the read on Barclays and UK banks more broadly.